Today, we have Mike Zlotnik, also known as Big Mike. He was actually a U.S. national chess master
I grew up playing chess and studying math, and I applied to investing.
and spent 15 years in IT in corporate America.
I had a 15-year career in the tech world, from rank and file all the way to corporate vice president. Defensive game is your long-term game. You're not trying to win the game fast, but you're trying to play the long game. It's all about downside protection and cash flow.
Mike, thank you for being here today. We really appreciate your time.
Vince, thank you for having me.
So you came here from the USSR originally, is that right? When did you first come to the United States?
Yeah, I came in 1989. I cracked this joke. There's a famous James Bond movie, From Russia with Love. I didn't come from Russia. I came from Moldova, which was a republic of the former Soviet Union. And given the war and all the issues in Ukraine, people don't, like there's a negative connotation with the Russian Empire. But I was a political refugee from the USSR. So I came running away from the Soviet Union and the evil empire with my mother, and I became a U.S. Citizen and a U.S. patriot. So that happened in 89. I'm a U.S. educated, but I did learn how to play chess. I grew up playing chess in the Soviet Union. My father was a chess master. So but I played chess here too, and did a bunch of IT work, and then discovered my passion, which was real estate. So that's my journey.
What city are you living in currently here in the U.S.?
Brooklyn, New York.
Brooklyn? Okay, awesome. And what was it like for you coming over here with nothing, starting from scratch on the other side of the world? Did you know English, or did you also have to learn a completely new language as well?
So I learned how to write and read relatively well in school, but I didn't speak English. My spoken English was pretty poor. But I came, I was still just under 18. I picked up enough English by going to school here. So yes, the answer was written and textbook was there. Just the language skills took living and breathing the American way. So.
How did that chess journey kind of unfold? Is it something that you had been doing since you were a kid with your father? And was that kind of running alongside this more traditional path of go to school, get a good job in corporate America? Or were you just fully focused on chess and then eventually switched over to a more corporate track? I'm not sure if chess would be a full-time career or if people are often doing something else as well. I'm curious if you could dive into that a little bit.
Yeah, it's a great hobby. I grew up playing chess and studying math in the Moldova, former USSR. I did it from childhood. Never thought about it. I learned a lot, I have a new book that's coming out. Really, it's called The Investor's Endgame. It's learning real estate from the experience of a chess master, me, because I learned a lot through chess, and the best methodology to self-improvement and learning is learned through chess. One of the best methodologies. And I apply it to investing. So every time you play a game, you have to learn from your experience, and you get better in the next game. But to make long story short, I never played chess for a living, other than when I was young, right? That was, I wouldn't even call it for a living. I just this is what I did. Some people play baseball, some people play soccer. I came here, I went to college, and I played chess while I was going to college. So it wasn't chess is not a living, unless you're Bobby Fischer, right? If you're a great talent, if you're world level, you could probably make a living playing chess, but it's very hard to make a living playing chess unless you coach some rich kids for, $300 an hour in Manhattan on a private sessions. There's some people who do that, but it's not a thing that I wanted to do anyway.
What did you major in college? And then what did your corporate career look like before you started doing real estate? So I know that you were in IT for 15 years. I'm curious what college looked like and how that led into your corporate path that you had at the beginning.
Yeah, I went upstate New York. It's Binghamton University, State University of New York. Binghamton is kind of funny. It's a great state school, one of the best. It's the best money can buy in Northeast. So I studied math and I studied computer science. It was almost like expected. It wasn't even another option. You come from the former USSR, everybody becomes an engineer or computer programmer, kind of as a joke. But that's, I studied, I loved it, and after that, I had a 15-year career in the tech world, from rank and file all the way to corporate vice president.
That's a pretty long career in corporate America. As you were spending time in corporate, Did you feel like you were going to spend your entire life there, or did you have something pulling you towards something more entrepreneurial?
Yeah, so in my book, I talk about two freedoms. My first freedom that I achieved when I came to the United States, essentially freedom of life, right? Just American way of life versus being part of an evil empire like the USSR. And the second time I discovered freedom is essentially when I quit the corporate world and I went into real estate full time. But I discovered real estate passively in 2000. So this was 9 years before I went to real estate full time. So it's kind of midway through my tech career. I started investing, and in New York City, no cash flow. It's all appreciation game, but I was getting good deals. I was finding the right, paid the right price for the properties. So to make the long story short, I realized you can build significant wealth passively through real estate, and you can do other things. The money works for you at night while you sleep. And then later part, I discovered cash flow, which is the more important component of the journey. You achieve real freedom through predictable, steady cash flow. But the journey itself was first be passive for 9 years, continue to invest, continue to learn. And then I went full time 2009. I was a little burned out. I was a little tired from corporate world. And the journey to freedom was one day, literally 2009, just make the move. Don't worry about the rest. Because entrepreneurial journey is different from corporate America. You have to do the leap of faith and just go with it.
And what did things look like when you were passively investing for those 9 years? Could you kind of walk us through what was your role? Were you investing in syndications passively and putting 50K or 100K into each deal? What types of asset class were they in? And what did the returns look like on some of those? I'd be really interested to hear what that experience looked like in your passive investing journey.
Sure. So it was all passive investing in the assets I controlled and I knew. So all apartments and some multifamily houses in New York City. So it was all essentially not syndications. I didn't know any better. I was using my resources and some family resources to buy, New York City, it's apartments, and then you've got some small multifamily housing. So it was all about finding a good deal, knowing that's a good deal. The cash flow doesn't work at all. So the cash flow is terrible. So you're buying here for appreciation. And the returns are pretty decent. I recently ran a math. I still own a bunch of these apartments. And the best way to describe it, it's 400% a return in, let's call it, I ran the math about 20 years, right? So 400, you 4x your money in 20 years. It's not super fast, but it's not, it's okay. It's decent.
Yeah, that is decent, actually. Yeah, that's not bad. I bet that that's probably more than you thought it was going to be when you first started doing it. You probably thought that it was the top of the market. The numbers don't work. It can't possibly get better. And yet it did.
Yeah, it did. And on the way, you get scraps on the cash flow. Literally, you get a little bit of, scraps of cash flow. And I do remember vividly, I bought a 1-3 family house. This is the hilarious part. I didn't own it for too long. I bought it right. I got a good price. I had to put down, even a great price, I had to put down 25% down. And I was barely breaking even on the cash flow. I was sick and tired of that. I owned it for a few years. I sold it, made a small profit. And I said, you know what? That is not the way to get cash flow. So all I can tell you is that the New York City has seen the waves of appreciation. It's been periods of time where it picks up and then it slows down, flat lines, right? It's not all linear. So it's difficult to say, but what I can just tell you is that if you buy and you hold on for long term, the time will cure all evils, or will take care of the appreciation. It just happens.
Because it's bound to go up eventually, right?
Yeah. There's inflation and rents grow. It's just kind of like the best way to describe it. If you can hold on for long term, and residential financing, if you can get fixed rate, flat, low interest rate, when the rates were low, you could get very, very good financing. The rate on the mortgage, I actually have this basic rule of thumb or something like that. If your rate of appreciation is above the mortgage rate, you will always be ahead, no matter what.
Oh, that's so interesting. I've never heard that before.
It's very simple. There's nothing to think about. If the appreciation rate is 6% in a given area, even zero leverage, you have no leverage, But if you add leverage and you borrow money, at 4.5% or whatever the rate, you're always ahead. Your appreciation takes care of the business, even if you don't have the cash flow.
But that's almost never going to be the case, right? Because appreciation in most markets in the US is 3 to 4% per year. And even during the times where it's well above that, like in 2021, it was briefly 15 to 18%. That's rare. And now we've seen the last 4 years being almost flat. So if we kind of look at the averages, the long-term mortgage rates are usually around 6%, and the long-term appreciation rates is usually 3 to 4. So wouldn't that almost never be the case? Or what's your perspective on that?
Hold the horses. I will beg to differ. So I'll say
Okay.
that. So I heard this in residential. The historic rate of appreciation on housing is right around 6%. And I may be wrong. The 3 to 4% may be the number. But I thought this was always the case, 6%. And that's why I love that if you add some leverage, conservative leverage, you're in double digit.
Ooh,
Um,
that's interesting. That's
so again,
interesting.
housing, it depends on what market. And there are a lot of cyclical markets, and then this markets like Northeast where it's a steady eddy. And you can't look at short periods of time because you have massive valuation corrections when the interest rates spike. What we saw now was something we didn't see for 40 years. The interest rates were in a 40-year negative trend. So
Yeah.
something has changed. So I don't know where we go from here, but the general thought process, at least what I thought years ago, is that you appreciate on average maybe it's called 6%, and then the mortgage rate, yes, maybe historic 6%, but if you caught it during the period of time and you financed at 4.5 or even less, right? I didn't say 3, I said 4.5, and then you're in an area that average appreciation historically is like I can tell you where I live for many years, the average historic appreciation has been probably more like 10%, not even 6.
Oh, that
The,
is super interesting.
it's location where you are, and then I'm in that part of Brooklyn where it's a good area. It just continues to appreciate. Now the cash flow is terrible. Your rent to value ratio is absolutely terrible, but you're just holding for appreciation. It's a very different market.
So there are appreciation markets versus cash flow markets, and some markets can kind of give you a mix of both. I think Atlanta, where I am now, historically has been a decent mix of both, but it looks like the cash flow is largely going away in most areas here, unless you're using more creative strategies on the residential side, in particular. So that's interesting. I didn't know that it was so high historically, but I guess that's how you got to such astronomical prices there compared to most markets. At what point was the 2009 crash on your journey in real estate investing? What was going on for you during that time? How far in were you? Was that at the very beginning of your real estate journey? Did it impact any of the investments you had or opportunities that you were looking at?
New York City didn't see any correction at all in 2009. So the cold crash, it happened, right? So I saw the good old 401k becoming 201k, as they called it.
I never heard that. That is so funny.
Yeah, that was the joke of the GFC, right? You had a massive correction, and the market. I even remember this is part of the book. I actually have this in the book when I wake up and like I'm cold sweating and thinking about it. Like you lose a lot of money in stock market, and that's when I made the decision. I've had enough of the corporate world. I want to go into real estate to be in control of my own destiny. And I knew that I could find plenty of cash flowing real estate, especially then the markets were cheap. Prices have gone through serious correction, although you don't know how long a recovery takes. But my observation was crashes happen fast and hard, and the recovery is slow and gradual. At least this has been my observation, and that was the true after GFC. It took multiple years for the markets to recover, and then ultimately they went into the expansion.
Hmm.
So
I didn't know that New York City and that market didn't crash. I thought everything went down roughly 40%, but I was still not paying full attention at that time. I was much younger and I wasn't, you don't see it the same way when you're 19 or 20 years old versus if you're in your 30s or 40s at that time. I just didn't have the exposure to what was really going on in the markets at that time. Real estate is a team sport. You can grow so much faster if you're in the right room. The Launch REI Mastermind is a curated space for investors who want to move from hands-on execution to professional portfolio management. This is your personal board of directors. Inside, our conversations go beyond the tactics. We cover the decisions that actually change outcomes, structure, tax strategy, and capital allocation. If you want to build alongside a vetted peer network designed for the long term, apply for the Launch REI Mastermind at the link in the show notes.
Didn't have AI tools, didn't have a lot of this stuff. And by the way, the data, sometimes AI doesn't even know. But from what I've seen, you got, Southern California, you got the whole Sun Belt, Florida, they've gone through, some markets have gone down even 70%. I mean, maybe 40 on average, but it was a big correction. Northeast, steady Eddie. I mean, you don't see much happening here. I couldn't, maybe I wasn't trading. I wasn't buying and selling a lot, but the rents were being paid, was 100% occupancy. It's just and I kept rates historically a little bit below the market, so I always have 100% occupancy. It's kind of crazy how to think about it. But I don't think the market corrected here. I didn't see anything serious and sizable.
That is super fascinating. I really didn't know that. So that's news to me. I just think that's really interesting. Given that you are a U.S. national chess master, how did that influence how you approach real estate investing? Are you thinking 5 to 10 moves ahead, or does it change how you look at the strategy that you're kind of putting into place for your own real estate investing journey?
Yeah, it's a great question. So the best way I think about this, I use chess in the following manner. My father taught me this lesson when I was, 5, 6 year old. So even at that age, I was already playing games and tournaments, and was learning games. And the number one tool was to look at your own games after the games and analyze them and learn from your own mistakes. And you obviously analyze the games of grandmasters. So that whole experience was like this. So I played a game. I lose a game. My father gives me feedback, shows me the error, and he says, do you understand what was the error, and will you ever make the same mistake again? And I said, absolutely not. I'll never repeat this error because I learned the lesson. And he laughed and he said, yes, absolutely, you will learn, but you'll make a new one. So the same applies to investing. The same concept applies. You have to continue to learn, and from your experience and experience of other investors. And the last few years I spent reading some of the greatest minds in the investment world: Warren Buffett, Charlie Munger, Ben Graham, Ray Dalio, Howard Marks. And one of the most recent books I've been really reading is Howard Marks, Mastering the Market Cycle, and also The Most Important Thing. So where I'm going with this, that what I've learned through chance and through investing, defensive game is your long-term gain. Meaning that you start not by chasing high returns, but you start by building a solid foundational position. In chess, it's called a positional game. You basically don't want to take too much risk. You build very solid foundation. You're not trying to win the game fast, but you're trying to play the long game. And if you don't win the game and you draw, it's fine. So don't just take too much risk. Same is true in investing. It's all about downside protection and cash flow. That's the lessons learned. And like anyone else, I've participated in this 2022, 2023 correction in the multifamily. And what I saw was that aggressive investing can backfire. And a lot of people paid the price. What worked was a darling of investing for many years became an Achilles heel. And like many other folks, I've lost money in that cycle. And what I did learn is the steady strategies like industrial, open air retail, that were conservative leverage, fixed rate debt, predictable long-term tenants. They worked, and they worked almost at 100% rate versus some other aggressive strategies, ground up development or redevelopment, heavy value adds. They took too much risk. So how does chess correlate with this? It's a positional game versus aggressive attack, and you take too much risk, and if it doesn't work out, you lose. Versus positional play, make sure you feel good about your investments for long term. And another important lesson is to look at kind of bad case scenario. So as you go through chess, you don't try to analyze every possible move. It's almost impossible. But you're trying to look at the range of possibilities. What could opponent do? Can the opponent do this? And then you basically see in the worst case scenario, what's kind of your worst outcome. And you prepare for that. And then if you do okay in the worst case scenario, then you have a good positional kind of game. And then same is true in investing. You're avoiding the losses. If you can avoid the losses and get an adequate rate of return on the good files, once in a while you'll hit a home run. Once in a while you'll get a great opportunity. Either the market will suddenly be your tailwind, or you just find a great deal and you'll do well anyway. Just loss avoidance, as crazy as it sounds, is more important, and that's why cash flow. So we'll get in a second. I'll give you kind of my buy box, but today it's all about cash flow. I have a very clear don't buy box and a small buy box.
Got it. So the don't buy box is most things. The buy box is a small number of things that we'll get into in a minute. So you think that cash flow is part of that downside protection process. And for investors, it's probably don't get over leveraged, don't chase the hot thing, because the way that things are looking today, it might not always be that way. So you probably have to be pretty conservative in your underwriting. You have to know that you're not going to get knocked out of the game. You want to extend the game, and you're going to get some big wins naturally along the way, whether it's your own skill or luck. What kind of role do you think that luck plays in chess and in investing?
So chess is a game of little luck. So there's plenty of other games of chess. Any kind of dice game, card games. Poker is one example. There are games of chess, games of chance, but they have a significant impact from the skill. So chess is a great example where the element of a chance is removed. It's not completely removed. Of course, you can have some bad day, or you get lucky and the opponent makes a mistake. But in general, the chance plays a very little element. In investing, the chance plays a significant element.
Yeah.
In fact, this is something that investors should really, really prepare themselves, that the range of possible outcomes is significant. And even though you may expect that on average you'll make, let's use an example, a 10% return, you'll have plenty of scenarios where you're going to lose money and plenty of scenarios where you're going to make 30% return. So again, it's difficult to see, but in investing, the whole game is about looking at the range of possible outcomes. Under what circumstances can this deal go bad? So interest rate spike is one risk. You basically, in investing, it's all about risk analysis. And again, you brought an example of a chance. So chance or the broad possibilities of outcome is something that investors need to be prepared for. What you're trying to do in this defensive investing is prepare for even the worst kind of case scenario. You don't lose money. So what does it mean? We talked about cash flows. It's not just the cash flows. It's the predictability and likelihood of the cash flows to be long-term steady. There's always still uncertainty risk. A black swan event like COVID can happen. But at the same time, if you pick the type of deals that give you that cash flow that can do well no matter what happens, then you have that stability. Now, the world could still have black swan events. It could have, even you could be a lender. Using an example, you could be a first lien lender providing a mortgage. You are the bank. If the market corrects by 40%, you could still lose money. Just your impact is significantly lower. And I'm not telling people don't play equity. In fact, playing equity could be one of the best things that you can do. Just remember, I have another very simple rule. Leverage. The higher the leverage, the higher the risk. The lower the leverage, the lower the risk for both the equity and debt holder. This is the crazy part. Most people don't understand this, but it's ridiculously simple. So 65% leverage, as crazy as people would like to go 75, even 80%, consider the fact that the lower the leverage, whether you're playing equity or debt, the lower the risk. Always.
That's something that really doesn't get talked about that much. I think a lot of times people are just trying to go max leverage because they think that they're going to get higher returns, but they don't even consider the risk part of the equation. And so I think it's really helpful that you brought that up. Could you talk a little bit about debt investing versus equity investing? I have had a brief intro to it. I have a rudimentary understanding of it. I think a lot of people don't know anything about it or understand it very well at all. Probably 99% of people. I'd really like to hear your perspective if you could explain it in simple terms and people. So if they hear that, they're going to know in the future what that means.
You could be the bank. Think of it this way. Private credit, there's been a lot of discussions recently about private credit. And some of them has been in bad connotation, lots of private credit. Loans to software companies have had problems, but in real estate, it's a little different, right? So you can invest in a mortgage pool fund. That's one example where the bank stepped out, a lot of private lenders stepped in. And when I got into this business in 2009, over many years, there were no bank financing. So we provided hard money loans, also known as the private credit. And what you're doing is you're lending money against the property, typically secured. As I said, golden rule is 65%. If you're pushing it to 75% or higher, you're taking more risk as a lender, and obviously the borrower has a higher potential, but if the deal doesn't play out, the lender can start taking haircuts. So the simplest and easiest way you could do it, you can invest through a hard money loan or a private note secured by a deed of trust or a mortgage. And if you do it in a fund manner as a pool, you're participating in a mortgage pool fund where they own, 300 loans, 300 notes, and they're all secured by properties. Now, most of them, just to be very clear, are short-term loans. Now, you have very few private long-term funds. In other words, when you invest in a mortgage pool fund, it's most likely its business is to loan money on fix and flip projects. That's the most common and typical way to participate. There are possible other options where the fund's a little bit more longer term. They're doing 2-3 year loans, but in general, it's up to 1 year, 6 months, 9 months, 1 year, fix and flip loans for these type of projects. That's a simple way to invest. You could make a loan to a friend who is doing fix and flip project. You're connected. You look at a property. The property is worth $200,000. You want to do, let's call it 50% loan. All you want to loan is $100,000. To them, it's essentially leverage. So they have a little bit of bigger upside, but at the same time, you want to limit your risk. So if you want to just stick with 65%, then it's $130,000 maximum loan. And as a lender, the hard money rates have been pretty decent yield. I mean, we're talking about you could loan the money in a 9 to 11%. That's a typical range. Can you do a little more? Like today, we when we do loans, because we don't do value, we can still get 12, even 13, 14% on a hard money loan. But if you're running a volume operation and you're trying to do heavy capital deployment, then you're most likely lending money at 9 to 11% if you are doing that conservative leverage.
That's really interesting. Thank you for explaining all of that. Hopefully it provides some perspective for people that just didn't really understand how those things worked. And you have so much experience in this that it can sometimes be hard to bridge the gap between all the knowledge that you've accumulated in your investing career, and then there's people that are oftentimes working in corporate America or in the medical field or something like that. And, there's just this large gap between the specialized industry knowledge that you have versus where they are. And they're trying to figure out, where do I put my money? Where do I invest? What's a good return? How do I know what's risky or not? There's kind of these basic fundamental questions that I think a lot of people struggle with. And so it's interesting to kind of hear you explain some of these things. And
let me add one quick comment
sure.
for more people to understand. So if people investing for cash flow, right, there's really only two primary buckets in real estate. One bucket is debt. Like you're playing the bank, you're investing in a fund that's loaning money like a mortgage pool fund. Or you're doing individual notes. There's a pluses and minuses to each. The alternative, you can do deals that you can invest in equity of deals with conservative leverage, but you're starting with the cash flow from day one. And I can give you some examples of these type of deals and kind of how we look at this. But if you're playing pure income, all you want is income, and you still got 10, 20, 30 years to work, just be aware that interest income is taxable, right? And unless you're using self-directed IRA. And if you're looking for tax efficiency and cash flow, then playing equity for buying it at the right price for the right strategy, like industrial or retail, you can get strong cash flow. These are the big buckets. Multifamily used to be in that bucket, but it's gotten way, way hard to find cash flow, and most people discovered it's an operating nightmare. So from a cash flow perspective, if somebody's in corporate America and they're looking for a way to write a check, they have to think of the debt versus equity, maybe both. And it's not just the product, it's who you invest with. You start who before how, like the book. And then ultimately you have to get comfortable into what you're investing, what project, what location, what leverage, who are the tenants, etc.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground-up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch REI to get started, or you can grab the link in the show notes. You had mentioned a little bit ago that you've read books from all the greats like Warren Buffett, Charlie Munger, and Benjamin Graham, some of the greatest minds in investing in history. Are there any light bulbs or takeaways that really stick out to you that you just felt like complete mindset shift moments for you, where it just really changed your perspective, or something was just so simple that it's such a great fundamental truth that is something everyone has to know about investing? I'm just curious if there were any of those moments for you as you were learning from them.
Yeah, from Warren Buffett and Charlie Munger, one of the simplest sort of lessons is that, it's changed over time, but I would say sit in your hands and keep learning and keep waiting for the opportunity. It's a patience type of a lesson, right? You just never be rushed to do a deal. The market cycles is a very important element. That's one thing that you definitely need to learn and study and understand. So market cycle, traditional cycle, has 4 phases. When you come out of a recession, it's a recovery, right? So you have recovery, you have expansion, you have higher supply, and you have recession, right? And understanding market cycles and how they apply to different asset classes is one of the most important lessons that you can learn. Mastering market cycle is not easy, and it varies by asset class, but understanding that these cycles happen, and when they happen, there's always, the pattern continues, it's just not always the same, and it differs for different asset classes. The other thing that, as I said, I use Howard Marks quite a bit. He's the founder of Oaktree, and I actually developed a methodology very, very similar to what Howard Marks and the way he thinks. It's very different, but I developed investment quadrants. So many people have heard of Robert Kiyosaki. He has got investment quadrants. Big Mike has his own investment quadrants. And I have 2 dimensions. One dimension is risk. The other one is dimension cash flow. So what I prefer to do is minimize the risk and focus on cash flow, but steady, predictable cash flow. And the way to think about this is just, if you start at that point, this is the lesson learned, start with safety and cash flow. It's very difficult to go wrong, and you will not get scarred, and your chances of negative experience will be diminished. What's a positive outcome? You don't hit a massive home run, you avoid negative experience. A lot of people get scarred and discouraged by negative experience. So don't get discouraged if you had that, right? Just learn from it. Learn, continuously learn, and not just the cash flow. You can have aggressive cash flow. Just stick with predictable, steady cash flow. Why? Because what you're trying to gain is you're investing and learning. You're trying to get positive experience and learning at the same time. Because if you get a whole bunch of negative experience, people walk away scarred and they don't want to do it again.
That's true. Like if somebody does their first real estate deal and it goes badly, they're oftentimes not going to do another one. But if they could just stay in the game, get small wins and keep going, then they may continue to the point where they build enough skill that they get good at it. So I want to take this philosophy.
Can I give you one example?
Sure.
So I have it in the book, and this is something that stuck in my mind. This is what I learned from Warren Buffett. I watched in great detail what Warren Buffett did during GFC, Great Financial Crisis. And the reason people should look at this is your ideal way to invest. It's investing with a great asymmetric return. So what Warren Buffett did, if you remember, he gave $5 billion to Goldman Sachs when the world felt like it was, ending. The economy was, we were in a free fall. And the way he structured it with preferred equity, which is a safer than common equity. He structured it with a great dividend yield. He structured with the massive upside. He had options to buy another $5 billion of their stock at a very cheaply discounted price. He had a dividend yield of 10% a year, was insane. And he had also a payoff fee, which was another 10% one-time fee. So if you look at this, where do you get an investment that gives you 10% yield? On a repayment, you get a 10%, 10 points, one-time payment, and you have an option to buy all these stocks. And executives of Goldman Sachs couldn't sell their stock. The reason this is such a great example is it's very hard to get. It's Warren Buffett, and the timing was perfect. But it paints you a picture of a perfect deal. Does it make sense?
Yeah. I'm just like, I want to link something together really quick, and then we'll get to your buy box because I'm curious to get into that. If we, and I feel like where you are with your mindset and your experience is so far ahead of most people, including me and probably most people that are listening. I want to take the knowledge that you have and distill it into something that's actually quite simple that would apply to almost anyone. So let's say that people are listening right now, whether they're making $100,000 a year, 150, 200, 250, even 300. A lot of times people have their income and their cost of living rise kind of simultaneously together, lifestyle inflation. A lot of people that are listening to this really have a strong desire to gradually replace their income with real estate investing and build more cash flow. What do you think is a realistic path of what people could do, whether it's 2 years, 5 years, over the course of maybe 7 years? How can they actually move through those steps to have enough downside protection and cash flow that they could start to look up in a few years and say, hey, I did it. I have more optionality. I could step away from the higher earning career that I had, and real estate starting to cover that for me. I'm kind of curious what your perspective would be like on that journey.
Yeah, that's a great question. And the answer is actually very simple, right? Ready, fire, aim. Meaning that you don't look for perfection, you look for action. Unless you're a sniper, just take action. So very simple, start. And you could find sponsors that you get to know, like, and trust. You got to connect. Investing in real estate, unless you're going to buy some publicly traded REITs, it's going to involve private investing. And private investing means connecting with folks. So once you build that know, like, and trust, start learning, look at their deals, and start understanding, improving your due diligence process. But you got to start. So the way to think about this, and I mentioned private credit, one example. So you could put the money to work and just see what they invest in, look at what's in the portfolio, get clarity on if it's a mortgage pool fund. You get your yield 9, 10%. It's not a great number, but it's a start, right? And it's not very tax efficient if it's not IRA money. Self-directed IRA interest income is perfect. If it's cash, it's taxable, right? But the point is, you get your yield, or you go into a triple net industrial deal or a flex industrial, and you get your yield, let's call it 7 to 8%, and you get your also tax benefits through depreciation, bonus depreciation, and you get your upside where you can make 15, 16, 17% return. Start. How much yield can you get on your cash? Well, in today's environment, right? I gave you some numbers here. You can get yield, let's call it 7 to 8% on equity if you get into the right type of deals. And on debt, you can get 9, 10, maybe 11, but you get no appreciation, right? You can do the math. You put in $100,000 and you get your first figure, right? Per year. Let's just say you can get 7, 8, 9,000, maybe a little more. Is it replacing current income? It's not. It's not enough, but it's a step. It's a step in the right direction. And what's important is to take action and learn after you make the investment. And obviously, you will underwrite and review and make sure that you get comfortable. But then read quarterly reports, talk to the manager, understand how the asset is doing. And you're taking small steps to start the cash flow, but you're not doing it at 2, 3, 4% level. You're starting immediately somewhere in, let's call it 7%, 8% range. That's already beating whatever the money market yield you can get. It obviously builds corporate bonds, but it's also giving you tax efficiency, and it's also giving you the appreciation potential. And one of the most important questions to ask, how the deal makes money. You need to understand, and what are the risks. These are the big things. How can you lose money, and how it makes money.
Oh, that's such a good, simple question that anyone can ask. I really like that you came up with that, actually.
I didn't come up with it. This is maybe it's kind of stuck in my head. I'm almost laughing at this because most people, like you said this, they don't pay any attention to risk. They just
No,
don't.
they don't. They just go, what return is this going to get me? And that's just a projection. You don't know until it's actually going and it happens, right? And so a lot of times investors will just pick whatever is the highest stated return, whether it's on paper, if they're investing with, an operator or a general partner, maybe in a syndication or a fund or something like that. Or it also is like that on the active side, where people just, I ran the largest free real estate investing made up in the United States. It happens to be in Atlanta with over 5,000 people. And I started to realize over time, I saw people being drawn to Airbnb arbitrage or trucking routes at some point, or, Airbnb just in general in 2021. And now it seems to be co-living and just putting up walls and packing 10 people in one house. They're just, what's the highest return without consideration of the hassle factor, how much effort is involved, how much risk is involved, how much leverage there is. All that stuff just goes out the window because they're just looking for what's the highest possible return. And they're not looking at it with all the factors considered that they should be.
Yeah, lots of great wisdoms, and welcome to the club. So I've learned it through the years of experience, and I have my battle scars. And today, the most important question is, what are the risks? Right? In commercial real estate, they call it sensitivity analysis. What happens if the rents don't go up the way you project? What happens if you have higher vacancy, right? We're just talking about these variables that could happen. And whatever the hot trend, whether you're active or passive, the investment decisions are very similar. Active, meaning you're running the show. Passive, you're investing with somebody who's running the show. So when you go passive, not only you have to still look at the deal and understand these variables, but you have to obviously trust the operator that they're going to be able to execute, because you're entrusting them with your money. It's a risk, but it is one of the risks. The other risks are critically important. So investing for the top line without consideration of the risk is going to be a very expensive lesson. You're going to get a PhD in the wrong investing.
That's so funny. Oh my gosh. But yeah, that's critical to avoid that. Like that could be $100,000 mistake. And that's the reason that we have this podcast. It's the reason that we're creating our mastermind community, and the reason we're putting together our newsletter and sending that out to people is we want to create this baseline of education for people so they can avoid six-figure mistakes. They can find opportunities at cash flow. They can find people that they can trust, that they can do deals with or invest with. It's, creating this ecosystem for people so that they can avoid mistakes and invest in places and deals that will hopefully get good returns, so that they're not just off doing this completely by themselves, which is a really difficult, lonely, and risky path to take. But that's what most people are doing.
Reminds me, one of the most important lessons that Charlie Munger, and kind of young people don't even, he's like the old guy who Charlie Munger passed away, but he said this: always invert. And the wisdom of that lesson is how you can go wrong, how you can lose money. You invert. Instead of how much money you can make, is you start with the reverse. You're inverting how you can lose money on this deal. And by looking at possible scenarios of complexity, of execution, of risks related to the interest rates, risks related to the tenant not paying rents or rents not going up, et cetera, you basically will build yourself a case why you're not going to lose money. And if you basically, there's no guarantees. There's still scenarios how things can go catastrophically wrong. Somebody can drop a nuclear bomb in New York, right? I mean, but if you eliminate the absolute catastrophic risks and you stick with more practical risks, you'll see in 99 out of 100 cases you don't lose money, or that number you get a lot of confidence, and then you projected a return of, let's call it 13, 14, 15%, it'll look much better than you're going to get a projected return of 22%.
Right.
But 30% of the time, things can go wrong. Then
that's a good point.
I have this concept that I've used so many times, and it is a holy grail of institutional investing, and most retail investors or individual investors don't know this. It's called risk-adjusted return. Very simple words, but it means is you are adjusting your return potential for risk. If you think in these terms, then you'll wake up and you'll start looking at risks. Not for any other reason. Risks are boring. Risks are not fun to look at. But what it does, it saves you a lot of aggravation later. So by downside protecting is what is saving you from that concern and aggravation. So long story short, remember Charlie Munger, these words invert. Always invert, just trying to see what could go wrong. And then if you get comfortable with that, then the bright side will look way better.
I want to make sure that we touch on what your buy box looks like and what opportunities you see. And then from there, we'll start to talk about, where people can find you, podcasts, your new book, and we'll make sure that we grab that link and can put it in the show notes. But what does your buy box look like today?
So it's really simple, right? So first of all, I look at least 2% positive spread between the capitalization rate and the interest rate. So for those folks who don't know what is capitalization rate, it's simply rate of return on your investment unlevered. So if you buy a property for $1 million and it makes you $60,000 a year income, 6%. You divide the income by the price you pay. That unlevered rate of return is the cap rate. It is used in commercial real estate. It's called something else in residential, but it's without the mortgage. It's your income minus expenses, not considering debt service. So if your cap rate is 8.5%, like we're doing industrial deals right now, so they trade 8.5% purchase cap rate, and we're financing with a bank loan of 6% or even 6.5%. That's a positive spread of 2% or more. That 2% is a magic number. The magic works. It doesn't always have to be 2%. It's almost impossible to find that in storage or multifamily unless you're getting a really strong deal. But in industrial, it's the norm. It's been the norm for a long time in open air retail. So why 2%? Just the numbers work. You could run the math calculation. Just trust me. If you have the positive spread of 2%, you'll cash flow well. You'll have plenty of margin of safety. Even if some tenants leave, you can manage it with better occupancy, and you can manage it with worse occupancy too. There's of course a break-even occupancy, but it just falls significantly lower because of that positive spread.
I've never heard that ratio, but I really like that. So a lot of times people might be looking for, I hear of people buying something for 6% cap rate, but I know that their debt for sure could be in these cases 6-7%. So that's a lot of them are not meeting that. But if they can get one for 8% and the debt is 6%, it meets that rule. My feeling is a lot of times debt might be around 7 on a lot of assets right now. For investment assets probably, but you would know better than me, but they'd have to find a cap rate of 9. That might be really tough to find. I have a feeling that this is probably pretty rare and there's not a lot of deals that meet this, right?
Depending on strategies. So right now in industrial and retail, open air retail, we're finding plenty of these opportunities. Very hard to find mobile home parks, multifamily, storage. The deals you see in storage, they're buying at a negative spread of 75 beeps. In other words, they're buying at, let's call it 5% cap rate and the financing is 575 or 6% of financing is 675. Negative spread, right? Certain asset classes, the story is always, well, we're going to run value, we're going to run improvements. And I hear this, I'm not negating it, right? If you're buying the property with 50% occupancy and you're still getting, a great price, you could, but you just have to be aware that's the heavy value add. Industrial, triple net, sale leasebacks, flex industrial, we're seeing plenty of opportunity like this. We're working on a deal live right now. We closed a deal in January. It was sale leaseback, meaning that the private equity bought the company. They're selling real estate, and then they're leasing back concurrently. And that thing was the spread was a little over 2%. The deal we're looking at now, as I mentioned to you, it's 8.5 cap rate and purchase, and then 6% financing or better. It's kind of, if you're not in that field, You don't know, but these opportunities exist. Now, can you do that on residential properties? Certain markets, but not in Atlanta. Probably it's going to be smaller town America. The reason I love commercial, you have economy of scale. Like you have to own a bunch of houses to be able to do this. So the answer is absolutely it exists in pretty sizable volume. You just have to be carefully picking. Not every deal that comes across, you're going to say no enough, but not 1 out of 1,000. It's more like the way we have relationships with people who bring us deals. We typically get such good deal flow that we get 1 out of 4 that we like. We probably turn down 3 out of 4 deals, and 1 is close enough for us to consider.
This is just so interesting. I could learn from you for hours and hours and hours. There's just so much knowledge and experience that you have, and you're miles ahead of where I am. So I've tried to ask good questions that can help provide a little bit of a bridge from where many of our listeners are to where you are, because I think most people are probably just not in the same place and might be missing a lot of that experience that you have. So it's really interesting to just hear you explain a lot of this and try and relate it to where most people might be on their journey. Where can people learn more about you, your book, your podcast, because you do have so much knowledge on these more advanced real estate topics, and it's really helpful and educational. So I appreciate all of it, but I'd like to hear where people can find all of your stuff and learn more about you.
Thank you, Vince. BigMikeFund.com. That's simple. So my podcast has a cheesy name, Big Mike Fund Podcast. So the website is bigmikefund.com. If they misspell it, forget the D at the end. You can go to bigmikefund.com. I promise it's not a kinky site.
That is so funny. I didn't know that you had that. That's so funny. Well, really, really appreciate you sharing that. And if you guys enjoyed this podcast, make sure that you follow or subscribe wherever you're listening. Comment below and share your biggest takeaway if you're listening on YouTube or Spotify. There were so many pieces of gold here and nuggets. So we're really grateful for your time and all the experience that you were able to share with us. So thank you so much for being here, and we'll catch you next time.
Thank you, Vincent. Small offer. Let folks go to the website, bigmikefund.com. There's a sign up for the book link. And if they sign up, again, forgive me, I don't remember where it is on the page, but it's there. When the book comes out, I'll send folks an autographed copy.
Oh, that's fantastic.
Time. And and if you got bored, you got nothing else to listen to, the podcast is there. It's just like you are. I really enjoy helping people and educating and just sharing with the world. It's kind of like what I call doing a podcast. It's a service to the world. It's not a revenue center. It just helps people, and it gives me the pleasure of helping other folks. And then one day, if you make a difference in somebody's life, that's already a win.
I agree so much, and that's really, really great wisdom to share. And it's so true. We can reach so many people with this platform, and we hope to reach even more. And of course, by people following the show, we're able to reach more people. We get pushed more by the almighty algorithms so that we can make an impact in more people's lives. So thank you so much for that, Mike. We really appreciate it. We'll certainly have to have you back in the future or involved with our mastermind community in some way, since you have so much to share with people. So thank you again. And until next time, just thank you. And we really appreciate you being here today.
Thank you, Vince.
If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchrei.co or check the link in the show notes. See you next time.